What is going on, everybody? Thanks for checking into our latest TDR Trade to Black podcast. It was roughly around 2 weeks ago that Verano Holdings announced a $75 million credit facility with Chicago Atlantic, which was a balance sheet move. But there's more to it than just that, not only pertaining to Verano, but the industry as a whole. So their managing partner or director, Peter Sack, is going to be joining us from Chicago Atlantic in just a moment to talk about that announcement, plus some of the trends that we should be watching heading into the final 2 months of 2026 and segueing into 2025, then segueing into 2026. So let's get into it. Welcome in AV here on our latest Trade to Black. Good to see you. How are things?
How's it going? Good. Good. This will be it's a good conversation. I mean, this is I don't want to say a sign of times, but it's a sign of positivity within the industry. It's the maturation of the capital markets and some of these companies being able to leverage these vehicles moving forward. It's positive.
These are the true in-depth capital markets conversations that we have from time to time. And Peter obviously has a lot of knowledge that pertains to that. So with that, let's welcome him back to the live stream. How are you, sir? It's now third week of October. Where does time go? But here we are. And how have you been? It's been about a month or 6 weeks since we had you on last.
Great to see you. Yeah. I'd say not as much movement into the space as we would like on the regulatory front, but the world moves on and people are still buying cannabis. People are still selling cannabis, and companies are still looking to grow and execute.
Yeah. Well, as I said off the top, there was a $75 million credit facility led by you pertaining to Verano Holdings that took place. I think if I don't have the date in front of me, it was roughly around 2 weeks ago. When we talk about that, this isn't about raising new money. It was about replacing old debt. What does that tell us about how operators like Verano are thinking about capital right now? Because it is extremely important knowing the current conditions of the industry.
Yeah, I think companies are looking to optimize their balance sheets, optimize the cost and the flexibility of their capital based upon both their footprint of operations and the assets on their balance sheet. And in the case of Verano, we were helpful in optimizing how they can utilize the real estate on their balance sheet.
Yeah, I noticed that.
Cheaper and more flexible cost of capital.
Yeah.
With this facility, I mean, this was a revolver. I mean, this is a very, I don't want to say unique, but it's a optimized vehicle for these operators to be using. Do you see the tier ones and the higher performing companies in the industry start to leverage revolvers moving forward as their cash flow generation profiles improve and the credit strength of these companies improve to really be able to utilize these vehicles to help them as they can leverage these versus just siloing cash on the balance sheet moving forward?
Yeah, absolutely. We've seen on the heels of Verano's announcement, we saw that Curaleaf upsized their revolver. Mm-hmm. And really, it's about flexibility, and it's about being able to make plans to execute, knowing what is possible on the balance sheet side of the equation, knowing what is possible in terms of what capital you can draw upon on a short notice. And so it allows an operator to be more flexible and more dynamic in terms of acquisitions, in terms of making CapEx decisions. It gives them certainty of availability of capital without necessarily having to draw and keep that cash on their balance sheet at any given point in time. And I think the other issue is the ability to be able to pivot from one credit facility to another as capital markets change. I know Verano, just like everyone else in the industry, including us, is looking forward to the potential for rescheduling, what that might mean for capital availability, both equity and debt availability. And borrowers want to be able to keep those options open. They want to be able to have capital available for that next acquisition that could happen in 3 months, but also know if in a year the landscape has changed dramatically, that they can refinance into different forms of capital.
Yeah.
With these revolvers and with these facilities, I mean, in the cannabis industry, we've seen a lot of the debt facilities be short term. How much or how are you thinking about duration as it relates to these facilities moving forward? Are these more short term duration vehicles, medium duration vehicles? Or does that even matter really in the calculus of these, especially as it's constantly revolving and the companies can be just leveraging it on a needs basis?
Mm-hmm. I think lenders in general are more open to longer durations, 4, 5, 6, 7 years, when the operator has diversification across multiple jurisdictions.
Okay.
Yeah.
That being said, in most lenders' mind, longer duration also means that they need more more that they need non-call periods or make whole provisions that say that if it's a 5-year loan, it needs to be outstanding for at least 2.5 years or at least 3 years. In the case of the Verano loan, it's quite flexible financing facility. But in most cases, there's a trade-off for better or worse. And many borrowers, in some ways, prefer shorter term in some instances because they're financing growth and they believe that in 2 years, the company's going to be in a much different position, much different cash flow perspective than it is today. And so they'd rather have something that's shorter, knowing that they'll be able to refinance at either higher quantum or lower cost of capital in 2-3 years.
How much do interest rates come into this equation as well? We've seen a little bit of lowering of rates, but we had Boris on probably Anthony, 3-4 months ago, and he said he's in no rush to basically refinance the entire debt because he's looking at interest rates possibly going down. But maybe it is a strategic move and get ahead of some of it right now, a portion. But I would think, in addition to a completely different landscape in the event that there is reform, is one, but I would also think that some of these people are banking on where interest rates are in 6 to 12 months, would they not?
I think there's part of that. I mean, in the cases of Curaleaf and TrueLeaf, they raised inexpensive long-term bonds back in 2019, 2020, the early 2020s, when interest rates were a lot lower.
Yeah.
And they're single-digit interest rates. So even if interest rates went down by a whole 1% in the next 6 months, he would still be incented to wait as long as possible and enjoy the low cost, those low interest loans that he raised 5-6 years ago.
Right.
I think cannabis capital markets are somewhat less sensitive to interest rate changes of 25 basis points, 50 basis points, simply because the rates are already so high.
Yeah.
For better or worse, that even Curaleaf and TrueLeaf's debt trades around 10%. And the same company that wasn't in the cannabis space would likely be able to get cost of capital of 6 or 7%. And so 25 basis points on 6% cost of capital is a lot more meaningful than 25 basis points on 10, 11% cost of capital.
Yeah, I bet.
With the situation with Verano, I mean, was that a unique situation, the fact that they had so much asset coverage and they own their real estate? And does that situation defer with, let's say, other operators if you were evaluating them to be sufficient to utilize something like a revolving credit facility?
I think Verano's certainly unique in the real estate portfolio that they've maintained within the company. They have not exercised a significant sale-leaseback strategy or third-party landlord strategy like many of the other MSOs have, and so that gives them more flexibility in terms of balance sheet options than others have. But that doesn't say that a revolving credit facility is an option for other borrowers as well.
What do you think is, like, just to understand, you brought like sales leaseback lending and then people owning their real estate outright. Verano is one of the few. Why do you think they chose that route?
I think that they looked at their hard asset base, and many people make the same decision. And they say, we're investing tens to hundreds of millions of dollars, in the case of Verano and many other MSOs, in these cultivation facilities, in these retail facilities that are the foundation around how they of their operations. And I think many choose and many prefer to be able to keep the value of that capital deployment in-house. I think secondly, that the sale-leaseback option is not cheap and it's permanent. And once you sell your cultivation facility or sell retail, you're locking into 10, 15, 20-year leases, usually with escalators, usually at cap rates that are higher than not similar non-cannabis retail cap rates. And so it creates incremental risk. It's another form of leverage.
So when you look at an announcement like this and you see the term flexibility, that's what you're referring to in some ways, yes?
Yeah, absolutely. Lack of permanence and a lack of penalties should the borrower decide to pivot and choose another source of capital.
Yeah.
If we do get reform, let's say in the next 12 months, what's the biggest change or the biggest pivot that you think we'll see in the capital markets as it relates to the cannabis industry?
Don't you love these questions, Peter? Love these ones.
And more so focused on the true nature of the capital markets versus the prospects of reform?
The first most significant change is access to equity capital.
Okay.
Like you're going to see a lot more equity capital flow into the space extremely quickly. The most dramatic impact, and you see some of the impact of that just when an announcement is made, when a Truth Social video is posted,
Yeah.
when a rumor starts circulating within the industry, you see prices of the major MSOs respond very dramatically and very quickly.
Mhm.
And you're going to see that happen, but also be much more sustained. That price movement and price escalation be much more sustained once there's more certainty around a rescheduling process, or once rescheduling is actually in place. I hope that that will lead to different considerations among the U.S. exchanges around
Yeah.
NASDAQ and New York
course.
Stock Exchange. I hope that will lead to greater flexibility around some of the plumbing of our investment infrastructure. I hope that'll make it easier for U.S. operators to list on the TSX, even
Uh-huh.
if NASDAQ and NYSE aren't open immediately.
That's a good point.
I suspect that large institutional lenders and banks that are not already servicing the cannabis space are going to be more open to considering it, but that's going to be a much more slow and gradual process than equity markets,
And
which are just more risk seeking.
when you say banks, you're referring to American banks?
American banks, yes.
Yeah.
Yeah.
So how fast do you think listings on the TSX could happen? Because that's an actually interesting angle.
Yeah, I mean, we've already seen some. We saw
Yeah, we have. Yeah.
Terrapin execute a listing. I think Curaleaf executed a listing. And it's possible that the TSX will be more flexible and in this process and be a first mover before New York Stock Exchange and NASDAQ. And frankly, I think it would be a smart play for them.
I think so too.
Because someone that lists on the TSX may decide not to uplist or to list on NYSE or NASDAQ because they see that TSX is strong enough.
Did it surprise you that to see Glasshouse get listed on Robinhood after we've seen just objections over objections of these online brokerages not being able to custody and trade the stocks, and we're now seeing a U.S. plant touching business that's not traded on a major exchange granted access to a platform like Robinhood?
Exchanges can be so fickle.
Yeah.
I tried to buy a Bitcoin ETF today in my Merrill Lynch account, and I couldn't do it. And that's not OTC. It's just an arbitrary restriction. And so I'm not surprised that Robinhood is among the first, because they have a really strong retail day trading network.
Yeah, they do.
And that is the exact holding base of U.S. cannabis operators is retail.
Yep. And I know we have earnings. I know you've got earnings coming up, I think on the 4th. How, without, I guess, diving into specifics, I mean, how's the pipeline looking? How's this quarter? How's activity, not this quarter, but how's activity looked in the sector? Are you still seeing plenty of activity and companies that are out there looking and warranting capital allocation?
Yeah, we're so close to earnings that I'll avoid specifics and avoid the vehicles. But we've seen, I think there's still a lot of activity. As I said at the beginning of the call, there's regardless of what's happening on speculation of rescheduling, companies are still selling cannabis, still growing cannabis. Companies are still looking at their neighbors next door and thinking, gosh, should I be in this state? Should I be in this part of my same state?
Yeah.
I've had success. How should I leverage that into growth? And thinking about that within the context of how our industry is moving, or how our wholesale prices flat or compressing or growing in some markets, how our same store sales and retail changing, and regardless of federal expectations, those are still conversations that we're helping our clients and prospective clients navigate every day.
What's the sentiment right now? We hear talk like we need reform. It's a moment of truth for the industry. And that's just the reality. That's just what we're in right now. But as you said, more equity capital, being flown into the industry if we get rescheduling announced, which would be welcoming. But there are some good companies out there. The timing, as we've had conversations with, has been very challenging for many players in the space that actually do have some decent brands and a great model. But what is the sentiment right now from you're hearing from a lot of your clients and potential new clients, the industry as a whole? And what happens to a lot of these companies, like you said, in the event that rescheduling does happen and we do see more equity, being invested into the actual overall industry?
Yeah. My advice to my clients and how we operate our business is to focus on the things that we can control.
Right.
And on the things that you can't control, execute, assuming that the potential pathways don't go the pathways that you would like them to go.
Yeah.
Mhm.
And I think that's the reality. And I think people that have operated under that mindset over the last 5 years um, uh, are probably better off for it.
Yeah.
Very much so.
Can you imagine in 2014 having a conversation with somebody in this space and saying, in 2025, by the way, there's a guy by the name of Donald Trump is going to be the president on his second term, and rescheduling is going to lean in the hands of President Trump. Where do I sign? You know what I mean? Like, it's wild to think of the times that we're in right now. But I do believe he's a transactional person. He has commented a little bit, and I do think something's going to happen. But the timing of it all, nobody knows. It's got to be calculated. And with that, that's anyone's guess. But
Yeah, well, I think it's never been more likely since 2014 than it is today.
yeah, good point.
I think it's a great point.
What has surprised you? Anything in particular when it comes to the growth of the industry over the last 6 to 9 months that has caught your attention? You don't have to talk about any specific companies, but besides synthetic hemp, what has maybe grabbed your attention that's grown a lot in the space right now?
I think we're seeing same store on the retail side. We're seeing same store sales declines across a lot of relatively limited license markets,
Yeah,
and I think it's forcing a lot of operators who rested their laurels on regulatory moats to execute much more disciplined, organized retail strategies than they did previously. In places like Arizona, where there's only 150 retail licenses, is seeing double-digit retail sales declines year over year, and some of that's price. A lot of that's price.
Mhm.
But in some jurisdictions, it's also quantity.
yeah,
And I think it forces everyone to be better operators and to think much more strategically about how they're deploying capital going forward.
yeah.
Do you think the MSO model evolves over time and is forced out of this limited license environment, and eventually like the walls come down, and I mean there's a true free market? I don't want to say true free market, but because it's always going to be under the pretenses of everyone needs to be licensed to be in it, and there's obviously qualifiers to transact in that market. But do you see these walls coming down on these limited license markets, such as Arizona, Florida, and that cohort of markets, and every state at one point down the road may resemble Colorado, California, and the strongest survive from an
I think
operations perspective?
I think there is a lot of reversion to the mean, and that's
Yeah.
both wholesale prices declining in limited license markets, and in some cases, wholesale markets rising and normalizing in non-limited license markets.
Yeah.
Hmm.
And when you look at some of the Cannabis Benchmarks, puts together some great data sets on wholesale pricing trending over time, and you see a big grouping of markets where wholesale prices range between $1,500 to $3,000 a pound, and then you see a big grouping of markets where wholesale prices are under $1,000 a pound.
Yeah.
Correct.
And over the course of 2025, you've seen a lot of the limited license states with high wholesale prices show modest declines.
Hmm.
And you've seen some of the much more competitive markets through margarine show increase in wholesale prices. These are places like Colorado and Michigan.
Hmm.
And
Michigan.
part of that's rationalization. The dollar numbers are more modest because you're starting from a lower base, but still seeing what are significant percentage increases. And when you're selling, if you're in a position where you're selling at your marginal cost, and this price at which you can sell goes up by 10%, that's extremely meaningful for your company's profitability.
Absolutely. I mean,
Yeah.
do you see? So would you consider, and maybe this is a loaded question, but do you consider a market like Florida flawed to a certain degree because we don't have a wholesale market? And I mean, I don't want to use an OPEC analogy, but in Florida, if you wanted to keep pricing stable at retail, the MMTCs could essentially just have an unspoken agreement to where it's like, we're not going to cause price wars. You're not going to cause price wars.
Yeah.
Let's keep this stable to a certain degree and artificially just keep the market afloat. if that makes sense.
Not a bad idea.
Yeah, I mean, you certainly could happen. I think today you're still seeing operators building retail,
Yeah.
and I think part of that's driven by, I mean, besides the fact that they can, because the license permits them to build as much retail as they'd like, but it's a state where jurisdictionally it's not necessarily that difficult to cite
Mhm.
and get permitting for retail. The cost of building stores and building inline strip malls on a per store basis is quite low,
Yeah.
and leases and lease rates and real estate costs aren't quite high. And then you add that to the fact that the operator needs retail outlets in order to provide a channel for its sales, because there is no wholesale market. It
Mhm.
creates a lot of incentive for operators to continue to build retail. And so even while you might have same store sales declining among
Yeah.
some of the operators, they're offsetting it by building out new retail. And the
Yeah.
average revenue per store in Florida is somewhere between $2 and $3 million. And
Yeah.
it's so low, driven by a lot of these dynamics that we laid
When
out.
so when you're looking at retail and when you're underwriting retail in food in the restaurant business, what we've seen is Uber Eats, DoorDash. The paradigm shifted from, let's say, brick and mortar being the end all be all to now it's on a delivery economy. In Florida right now, you can get hemp delivered to your house via DoorDash. I'm assuming the natural evolution is going to be cannabis will be sold into those channels in the future. Do you see there being less of a demand for brick and mortar and a more emphasis on, let's say, fulfillment centers and quick stop cannabis dispensaries versus what we're seeing in the future as the industry evolves? And do you take that into consideration at all at the present time in your underwriting or when you're evaluating markets?
Yeah, I think having sufficient vault space in your retail to support delivery fulfillment is important. I think there are certainly early movers within the medical market today that are executing really strong delivery strategies
Hmm.
and making a lot of investments both in infrastructure, processes, and technology to be able to
Yeah.
enable that.
Yeah.
And it helps them build market share and retain market share. Um, but you already ease of access for the customer is hugely important.
Yeah.
Drive-through locations, drive-through can be a huge asset for
Hmm.
a retail location, and delivery is just an extension of that same thesis.
Yeah, I agree. I think delivery will be a big one. But when you look at party stores and alcohol, you go in, you probably buy something different. I don't want to say every time, but you're not always buying the same product. It all depends the mood, the time of day, the time of year. Does that apply? Maybe, Anthony, that's a question for you. When you talk about cannabis consumers, is it the same thing every single time?
You're much stickier, or at least I am with my purchasing habits in the
Yeah.
cannabis vertical than in the alcohol vertical. I mean, because you're correct. Whenever I go to a liquor store, it's like, yeah, I've got like what I usually prefer, but I can easily be swayed depending on the merchandising and depending how my mood
Yeah.
changes once I go in that store. If I'm going to like the flowery, I know exactly what I'm buying. It's already pretty much in a basket when I get there. I'm taking it and leaving, and there's
Yeah.
no optionality into what I'm buying. And I would do the same thing for the most part when I'm in a dispensary in Colorado or California, which is more of a portfolio approach versus the branded approach. But yeah, there's no that
Yeah.
optionality is very few and far between, I would bet, in the cannabis space versus the alcohol space.
Hence the reason why I think delivery could be a big component, moving forward. But listen, we'll leave this off with you, and I'm not giving any timelines, but we keep hearing rumors that let's just say rescheduling, it does happen sooner rather than later. What can we anticipate, as far as any changes? As you said, more equity capital dedicated to this industry. We're going to see a lot of changes. We'll see in the short term, shares probably spike quite a bit. And then once they level off, I don't think you'll get the pullback to what we've seen in the past, but we'll be on to that new sort of like era for the industry. But from an operational standpoint, what are you prepping for?
Prepping for, I think a lot. Well, I think a lot about rescheduling doesn't have a significant operational component.
Yeah.
Doesn't change how we sell cannabis. Doesn't change how it's grown. Doesn't change state-based
Yep.
state-based licensing mechanisms. Um, I think I think folks are going to be. I think there's going to be a lot of M&A activity driven by operators looking to leverage their success and to leverage new cash flows that they're generating. And I think a lot of operators have been waiting on the sidelines to exit and to monetize what they built, to see what valuations will look like in a post-rescheduling world.
100%. I think whatever rescheduling does, it's going to fast track on what we think is normal right now and how that is just going to it's going to move real quick. And the cannabis industry, as you know it, will be changed forever, but nothing stays the same. Listen, always good catching up with you, and look forward to chatting with you in a couple of weeks again on your latest earnings. But thanks for giving us kind of an update as to what you're seeing from an industry perspective and things to watch for. But let's keep in touch, okay?
My pleasure. Thanks for taking the time.
Right. Thanks, Peter.
Awesome. Thanks, Peter. Hey everyone, thanks again for watching here today. Listen, if you're getting value from us here at TDR, make sure to check us out at TDR Plus. It's our exclusive membership community. Why? Well, you'll see CEO interviews that go beyond business, showing a personal side that you won't find anywhere else, including the biggest names in the industry. Plus, you'll get insights from analysts and day traders on where the industry's headed, both short-term and long-term, and a direct chat group with our team. It's only $7 a month, just 25 cents a day, and it helps support everything we do here at TDR. If you want to join, just click the join button below and become a TDR Plus member today. And once again, a big thank you for being part of our community. So that's it for today. And again, thanks for watching, and I'll see you next time.